Hi, folks. It's Ada and CryptoBurp speaking. Welcome to today's Friday webinar. I'm excited. I'm happy. I'm smiling because there is a lot of potential, a lot of promising days ahead. However, there's been a lot of difficult events going on for the past weeks, and definitely the markets didn't like the overall 50 basis point rate hike presented by the FOMC on the last Wednesday. Well, how can we explain today's Bitcoin dump and why actually, the Bitcoin turned to the downside and what is the potential outcome? What is the potential future? Let's have a look in the predictions throughout today's show. If you're ready, make sure you stay tuned. We are going there right in a second. Welcome, everybody. Let me know how you guys are doing. It's Aiden CryptoBurp talking to you straight about today's, Bitcoin topic. The main topic is, why and how, Bitcoin actually just dumps, because that's definitely been a lot of noisy price action going on throughout the week, especially lots of price action depended on the actual CPI prints, which came in a little bit more positive than expected, lower than estimated. At the same time, it was naturally immediately followed by the FOMC decision, which overall did hit and take a toll on the markets, and the markets didn't like it at all, despite the anticipation that had risen prior to the actual event announcement. So we're going to discuss this and more, and how we actually just can position ourselves into the future. The question is, can we really know and can we make money of trading not knowing the future? And the answer is yes. You don't have to know specific, price action. You don't have to guess specific price patterns that are going to come up in the next 2 days, in the next week, or in the next year. You don't have to guess and have this crystal ball to try to, again, literally tell you what the story is going to look like. Instead, you can adapt to it and basically accept that you cannot predict the future, and try to minimize the risks whenever there are elevated volatility, whenever there are elevated chances of your being wrong, so that you do not overinvest at that times, and you put a little bit of your leverage over the capital, not necessarily literal leverage and then borrow capital, but play a little bit, just maybe more risk aggressively, and when the conditions are good. So let's have a look what's been going on throughout the week. Well, let's start with a little bit of announcement from my side, because some of you know that I've recently hosted great one and only and amazing legendary Julius de Camp, or the creator of the relative rotation graphs, RRG, who is also part of stockcharts.com, an amazing platform that I use for charts. You're going to see it throughout the show. But I spoke with Julius, and he's such an amazing and interesting individual with tons of experience, and we had this honor to have him on a congress, and I had a talk with him basically when he mentioned to me that the CMT Association is still celebrating their 50th anniversary. The 50th anniversary is something like big, right? So they're going to host a symposium in April, the annual symposium in April in New York. And there's me being freshly accepted into the CMT community, charter market technicians. I'm definitely paving my way into the very symposium. So if you guys are around that time in New York, let's definitely catch up, because that's where you're going to find me. And straight about the markets, well, what we can tell today, is definitely that there's been follow through to the downside. The markets, again, not only didn't like, this overall declining power of the buyers, and overshot, price action with the fake outs one after another. There was not sustainable trend to the upside, right? There was no follow through, and every time the market just broke to the new highs, it then validated those highs soon after, invalidating this polarity change principle, right? And kind of like repeated this distributive process a couple of times on top, which aligned overall with this bearish divergence. The next chart, before we've continued the full review, just shows you and actually responds to something that I had been mentioning for quite some time already. This bearish Dow divergence, right? Dow divergence, which invalidates, or should I say negates, disrupts the Dow theory. The Dow theory tells you that when the trends are sustainable, whenever the averages confirm each other, right? Whenever the Dow Jones Industrials, which is the one on the top, and the Dow Jones Transportation average move in the same direction. However, for quite some time, for most of the November and ever since, we've been seeing a piling up, sequence of higher highs on the Dow Jones and lower highs on the Dow Jones Transportation. So this tells you there's this disparity and this divergence in terms of the direction, right? And when one market is showing, this overall deviation to the upside, the other is showing deviation to the downside, and this causes a lot of imbalance. This causes a lot of puts the market out of the like healthy equilibrium, sustainable, efficient market, if you will. Moving trends, moving in the direction of the trends. So this tells me instead that the markets, lost their credibility in terms of the prior lasting trend. So this was a massive morning. I was posting about it on Twitter quite some time already, ever since I noticed this divergence. And what it tells you is that, well, this doesn't necessarily need to mean that, okay, we're back into the bear market, because note that the 200-day average has flattened out for the first time this year. We are actually looking at a fairly flat moving average on the 200-day basis, right? So this tells you that the primary bear market trend, which had kept declining for most of the time this year, had definitely absorbed many more buyers, and at the same time, much more buying pressure. And this tells you, that there was this kind of like mode change. There was this mode shift, right? That the market switched from declining to this overall more sideways territory. So it doesn't mean it's a proper bull market per se, but it means the previously lasting bear market kind of like, has changed, or at least has changed in terms of the pace of the declines, right? I hope it makes sense, everybody. Please let me know if you have any questions. I'll put them, make sure we put them in the chat. I'll do my best to actually cover them and review them. There are a couple of more charts that I wanted to list for you today. So the Dow Jones Industrial, again, this divergence against the Dow Jones Transportation, it tells you that this trend, that had lasted, this strongly upward lasting trend, was definitely lost its sustainability, and as a result, we're seeing the continuous decline following the series of fake breakouts. So this, of course, comes with the S&P 500 weakness, which didn't manage to kind of like catch up with the industrials, right? So those typically tend to move similar, right? So the bottom in October, same for S&P 500, right? However, the large caps, had been quite often and repetitively, lagging because of the bearish earnings seasons that were announced, every now and then, and that are announced every now and then. And this definitely, for the industrials, you can tell that there was this strong downwards, again, primary bear market, which is flattening out the curve. For S&P 500, it's not flattening out just yet. So the S&P 500 has, again, this diverged again a little bit, versus the Dow Jones Industrials, which is not so much of an alpha occurrence, at least this year. And well, it tells you that the S&P 500 is underperforming the Dow Jones Industrials, right? So the Dow Jones is being right at the support at the bullish crossover for the 50-day average as well over the 200 days. So this prints overall, arguably, the medium-term buy signal on its own and of its own. However, of course, it's best if it's timed with other indicators, for better accuracy. That said, we're still talking about the sharp reversal of October, which is quite often bottoming month for stocks, as the history shows. And this mean reversion, this pullback, this breakout retest sequence, has definitely acted aggressively upon, and then impacted other markets. So it means, again, we've seen this massive overshot, and then lost chance, this failed breakout double top, if you will, and a little bit, pattern, which definitely would take us lower, on the pattern basis itself, right? Because the measuring move, a rule would tell you that you want to measure, well, more aggressively or more conservatively, the targets from the highs to the lows, and apply that from the breakout level if it forms some sort of like a pattern. Here, arguably, you could call that a little bit of a double top pattern locally, yeah. So of course, this is a little bit more complex, distribution structure. However, here, you could argue that this move from 3,900 all the way up to 4,100 is going to give you 200 basis point here, kind of like a breakdown potentially measured from 3,900. It would technically put you with a target at the lows of November, at the November's lows. So this is the potential technical target for a breakdown for the S&P 500. If that happens, this definitely does not promote extremely bullish territory. Ideally for the stocks, it would be for Dow Jones to kind of like bounce here, right? and the S&P 500 to, of course, just not kind of like fall below the lowest end of a support, for that 50-day trend, instead kind of like rally back higher. So I'm spending a lot of time basically explaining the stocks because those come with very interesting and a very strong inverse relationship with the Bitcoin that I'm soon going to cover as well. But other than this, we're looking at Dow Jones Industrials kind of like overall seasonality. And this overall seasonality tend to be over the past 125 years. 125 years of certain patterns, detrended. This is the trend, kind of like ignoring the price trends. It's showing you the typical average, incline and decline on some relative basis point measures, and showing which months technically like to perform better over the past 125 years. So again, this is a large sample of data. This is not some sort of like, just tiny sample, and we are not risking the representativeness bias here, basically, because we are talking about a large sample, a big pile of data that is actually validating all those patterns shaping in such a form. So you can tell that December is typically most of the time finishing the rally and finishing the month and the year strongly, right? So there's an overall inclining tendency ever since October, end of October, typically towards the end of a year. This is also confirmed, by the average returns, because this is basically a little bit of an average to seasonal average to confirm that. So you can tell there is this inclining tendency from October, November, December over the past 125 years, and it's typically kind of like still maintained more bullish than not in January. However, somewhere midway through January, this kind of like tends to get disrupted for quite some time. It extends the rally from December, but most of the time it kind of like, again, the second half of January tends to be bearish and initiating these bearish declines into the February. So of course, the past is never a guarantee of future success, is never a guarantee of future performance. However, if you take 125 years of data, of price market data, then arguably when it shows certain pattern, that this is very credible. So you can definitely adjust for it, in terms of your expectations, because if you know that the seasonality is on your end, then just maybe it's going to promote a little bit more risk favoring, situations and solutions investments. And otherwise, let's say if you know that February is typically a declining month, so I would myself, not necessarily want to allocate more risk to investments, to risky assets, to Bitcoin, to cryptocurrencies, to others, stocks and so on. When the conditions are not good historically, there are certain seasonal patterns, and it's not an accident, it's not a coincidence when those patterns maintain and are held over 125 years. There's a repetitiveness in that repetition. So the energy sector on top of that, and it was also kind of like showing a little bit of a distribution on top. Of course, this is something that I've been mentioning for quite some time. I've been making the posts, of course, in the Bourbonist exclusive corners for the premium subscribers, for a lovely community, as well as on Twitter. And where we were seeing, those tiny kind of like gaps, hopefully you can see that, but those tiny little gaps that were appearing here in this topish pattern, topish round the top, saucer, if you will, then those typically I refer to them as exhaustion gaps. But typically what happens is if you have a sharp move that is already exhausted, and it kind of like loses the steam, loses the trend, loses the momentum, then what you see is there's a lot of kind of like this shuttered, price action that tends to move with a lot of gaps up and a lot of gaps down when one kind of like annihilates another. So when such situation happens, and you see a lot of gaps getting filled, on the next day, on the same week, this high frequency of closing those gaps indicates that this is more likely an exhaustion pattern, a distribution pattern. And this is exactly the warning that came to realize and materialize, quite soon after. So we're talking about this declining tendency locally in a sharp decline within the energy sector for the S&P 500, for the ETF, XLE. And it's showing a beautiful technical setup, right? Broken support, broken neckline, if you will, followed by a breakdown retest to the upside, and followed by, again, a rejection of the broken support, which turns to resistance and validates this resistance even more. So this is a beautiful example of a polarity change principle that we know in the technical analysis language. And here, technically, because of that, the tendency is leaning more to the downside, and you can tell that there's this lots of downside selling pressure that may arguably take it to the proper complete mean reversion pattern again, finalization, completion towards 80 points, for the XLE. So we don't know if it's going to happen. However, there are some odds that are going to tell you that those last once those trends once they appear, once they emerge, they tend to last in certain direction. Most of the time, the markets are noisy, the markets are moving sideways. However, when there is this significant breakout and a follow through, what, like one of the great technicians, just comments on it very often, Dave Keller, great CMT. Then there is this follow through factor, and this follow through factor means basically that the move, just kind of like trying to stand out and then just overthrow, the top and make, despite it makes higher high, it doesn't necessarily need to be credible immediately just because of it broke to the new highs. It needs to close above it. It needs to close and actually just maintain, confirm with a higher move, with a follow through to the upside. And if it's an upwards breakout, that's only the way that kind of like you get to confirm that this entire breakout is valid, is confirmed. Same to the downside, right? Whenever you break out of the consolidation range, just like we would say, and see on this local pattern, this rounded top, it's not valid if this rounded top kind of like, again, just fakes the breakdown, right? If it breaks down, but if it fakes it and kind of like climbs above the broken support, above the neckline, then I would argue as long as it fails, to break above it, it's in a bearish tendency. However, if it's actually managing to climb above higher, then this validates another broken setup, another failed breakdown. And this is exactly what may reverse the trends, right? So this is why you're looking for 80% of the time, 70-80% of the time in the sideways noisy price action, full of chop and full of traps. And when there's market basically tendency moving from between the frames, between the support and resistance, and quite some, occasionally, not quite some often, 20-30% of the time at best, markets like to break out in a consecutive manner, again, to the upside or to the downside, which promotes trends. And those trends, once they get on the track, once they ignite, once they emerge, once they're confirmed with a follow through, they tend to last, because there's this momentum principle that tells you that, again, this money moving in the one direction of the breakout, coming with this overall emotional biases from the people, the fear of missing out, this recency bias or this regret bias that they had missed before. This empowers additional, drivers and the factors to empower the rally and or the trend in the specific direction. So, here, of course, is a dollar chart. Right now, dollar is bouncing a little bit after yesterday's decline and an overall decline following the FOMC, which was a little bit surprising. There was an overall withdrawal, the way I put it in the newsletter. There was an overall withdrawal, in the market, only in favor of the defensive markets, only in favor of the defensive stocks, right? So consumer staples, consumer staples, and utilities, perhaps not so much, because we're going to cover the relative rotation graphs in a second. But overall, this dollar weakness, local weakness, following this overall strong rally through the entire year, dollar is ending, with a sharp decline into the very support of the range, right? Because the dollar had been moving for like 7 years, since 2015 all the way to 2022. Now in this range between 88 and 104 points, arguably, and only this year it had broken. Right, only this year it's broken to the upside and then reverted locally to the downside. And this is a sharp reversal. This is a sharp decline for the first time, actually, somewhere in the directions of the 200-day trends. So there was a consecutive strong rejection and then a breakdown, and it's kind of like serious breach on the 200-day trend, which may show you that there's a larger shift. There's a greater shift in the directions of the dollar. So just maybe there is an underlying weakness that is actually not only going to make dollar stay lower, in the lower region, as in not kind of like rally back immediately towards the new highs, but instead kind of like stay in the lower region of this freshly created range, between 104 and 115. And arguably, it still holds a significant support at 97 for the 15-month average. This is a long-term average. And this definitely, this strong breakout shouldn't be ignored. However, the situation that the market, reacted so much negatively to the FOMC with so much withdrawal tells me that the traders are likely pricing in higher risks of not only of inflation but also the higher risks of proper recession, right? Because there are more likely than not, continued price hikes, rate hikes in 2023, right? As Jay Powell recently said on the FOMC announcements and the press release. So the conditions are not looking so good. The job market is overall, still stronger than expected, or still strongly enough holding the entire economy from falling. However, the deep yield curve inversion is telling you a lot, where the 2 year yields outperform heavily the 10-year yields. So this kind of like should be technically opposite, right? Because the longer maturities are going to serve you better yields technically, right? Because you lend your money for long, you get your money borrowed, you lend your money for longer, so technically it should pay you higher interests. So if it inverts, this tells you that there is this balanced, imbalanced situation in the market, and that traders lose credibility in terms of the overall, market conditions. So this tells you that the interest rate spreads and the dollar weakness here, coming with the defensive markets, rally, tells me that the traders are withdrawing from the risk, even withdrawing from the dollar, which is declining, started withdrawing from the dollar, but moving in and promoting the defensive stocks. And this is likely going to be seen in the relative rotation graph. But before we jump there, please let me know, guys, if you can hear me still, if you can see me well, if you're watching that. And a little quick note for everybody. This is to tell you, that I appreciate you watching this and tuning into this webinar. Back a year ago, in the peaks of the bull market, there were like hundreds of thousands of viewers, users, and people on YouTube watching that, and thousands of people watching live. Right now, it's completely different, right? There's definitely a lot of deterioration in terms of the impressions, the views, the engagements, and I'm fine with that, because we've been through the long ways, of the bear market. We've been through the bulls, through the sideways, everything, as myself and as the Burpnest. However, what matters and why I'm telling you this is because you guys give yourself the opportunity, or giving yourself the opportunity by watching video like this one, to actually prepare for what's coming in the better times. We've been definitely, into a very nasty bear market for a very long time already, more than a year. It's an exceptionally difficult macroeconomic situation. It's definitely, a lot of difficulties, a lot of black swans, and a lot of uncertainty, a lot of, exchange collapses right now going on, a lot of terrible news and events, of course, coming up every day. And there's, of course, Russia-Ukraine war. So Bitcoin had never faced such situations. However, you know it seems that on an overall basis, Bitcoin is here to stay. Yeah, so the long-term trends are still moving up, but what this does tell you, is that if you hold on to it, if you remain patient, if you give yourself the chance and an opportunity to watch video like this and learn when everybody else is capitulating, you guys may well be the winners. You guys may well be the outperformers, the big winners, the top winners, for the next bull run. So give yourself a round of applause. Congratulations to you guys, because what you're doing is amazing. What you're doing is great, and it's very brave. And congratulations to you guys. Give yourself a round of applause, literally in front of your monitors. If you're watching that on your phones, you deserve this. This is something great. Congratulations, guys. And back to the charts, so this relative rotation graph is telling you basically that, again, there's a distinct leadership in anything for that regards, the S&P 500 ETF sectors. That regards the leading quadrant, which is strong relative momentum and strong relative strength. So anything that is on the right, from the central point, from the 100 interception, which is the S&P 500 here, tells you that on the relative bands basis, it's outperforming. It's trending on the relative uptrend versus the S&P 500. It's outperforming S&P 500. And this tells you that on the portfolio management basis, if you are a portfolio manager, and you are, then you should be thinking, most likely, depending, of course, on your risk preferences, like, I don't know in person, so take it with a grain of salt. Everybody would have different preferences and different, goals. So it's everything is individual about investments. However, the overall rule of thumb, or the overall, knowledge is that you want to be overweight portfolio on anything that is leading, because of this momentum principle, because it tells you that because those trends tend to last and tend to persist in specific direction, This basically means that this is where the money is. Yeah. So you want to have in your portfolio the outperforming assets. This is 5 week basis uh, here, for the movements, and it's telling you that the XLB, the basic materials, or XLI, the industrials, or the XLF, the financials, XLV, healthcare, like Pfizer, XLP, consumer staples, and XLE. Those are the leading quadrant kind of like narratives. Those are the portfolio assets, types of assets and classes, groups of stocks that you perhaps would appreciate, if you overweight them. And at the same time, the momentum investing assumes they are you're long on what outperforms and short on what underperforms. Yeah, so we kind of like when there is a strong relative uptrend on, let's say, XLE versus the S&P 500, then you want to be long in what's going up and what's maintained to go up, and shorting at the same time something that shows a lot of weakness. And that, on the other hand, is exactly what we see, in this lagging quadrant. So this is an exceptional situation because we are completely clear in the weakening quadrant and almost clear in the improving quadrant. So it's telling you that it's a very distinct and polarized view that anything that you hold, let's say the energy stocks or the healthcare stocks, which are consumer staples, again, those are defensive sectors, recessive environment, recessive stocks, you know, maybe except for XLB and XLI, those are basically the leaders for the market. So this is what you should have technically as a momentum investor, in your portfolio, and have a little bit more weight to it when you compare that with risk aggressive stocks, which is like XLK, which is technology, or consumer discretionary, like with cars, durable goods, and XLI, or communication services, XLC. So what it tells you altogether is that this distinct polarization, this distinction, shows you that the market is rejecting the risk assets, and it's preferring, and it's actually favoring the defensive assets. So this is the withdrawal I was talking about, right? And why again am I focusing so much on this stock side, on the macro side, to it, on the financial macrofinance aspects, and this overall financial markets there? Well, it's because Bitcoin is interconnected in that. Bitcoin is not an isolated market moving in a vacuum. Instead, it's well connected to what's happening in the other markets. And as the history learns, it's actually exceptionally strongly connected with the stocks. So this is on the bottom of the weekly chart for Bitcoin. It's showing you the 7-week correlation coefficient. So it tells you how strongly correlated the market is, the Bitcoin is, against the S&P 500, because that's what it says here in the bottom corner. So Bitcoin is right now very strongly and negatively correlated with the S&P 500. Negative correlation coefficient tells you that the markets are moving on average within the tendency to move in different directions. So when the stocks move up, technically Bitcoin, at the same time as a response to it, should move to the downside. Another way around, right? So if stocks move down, Bitcoin should go up. So again, it's not 100% rule that it's going to always happen like that. However, it shows you this average tendency in the market, and you can tell that the last time actually it happened, it's not a common occurrence. In fact, the last time it was at these levels, if you just take it back to this regions, then it's 2019. So first time in the 3 years, in the last 3 years, we have actually visited those strongly negative correlation coefficient levels that tell you that on average, Bitcoin has quote unquote decoupled from stocks. Or decoupled, in fact, is one of the funny terms that many people use, unconsciously. And decoupling would mean most likely and more likely than not complete decorrelation, as in that the market is not correlated at all with the stocks. However, what it tells you is that it's negatively correlated, which means that, well, against the typical tendency when the Bitcoin and when the crypto and stocks move in the same direction as both the risk factors, Bitcoin right now is heavily underweight and underperforming the S&P 500 and the other stocks. So it's definitely far from being chosen by investors. So the same investors who pick stocks are not going to pick Bitcoin on average. That's what it tells you. In fact, those markets move tend to move in the opposite directions. And there are a lot of reasons for it, right? There is a lot of mining difficulty overall, and the mining costs, the production costs, are right now fluctuating at around $20,000. With the current prices of Bitcoin at $17,000, this tells you that this disparity, this difference, this gap isn't exactly what gives and puts miners in the very uncomfortable situation, because they're running the business underwater. Yeah, they're running the business underwater. So well, it's not necessarily the greatest situation for a lot of miners, because the smaller miners are not going to be able to operate, and they'll have to close down their businesses because the electricity costs are high because of the high energy prices. And at the same time, there's a lot of engagement on the network side of Bitcoin. And when there is a lot of miners competing for winning the block rewards, this definitely comes with the increased mining difficulties, and at the same time, this puts miners underwater. And this underwater market situation is exceptionally difficult and very unpleasant, mainly because it can lead to something that we know as a miners capitulation. Because if you run a business that underperforms and that just flows underwater, and it's negative, and it's just not only not earning any money, but it's losing your money constantly, and the question is how much reserve you have to pay for it, to invest in your business to keep it running. And I'm afraid that if the lots of miners have and experience this strong disparity between the earning costs, between the costs and the earnings, then they risk the capitulation. And if that happens, well, then it means that they'll have to sell off their bitcoins that they had been holding as the miners. So if that happens, this of course commits to the selling pressure. And if that commits to the selling pressure, it may easily just break the stop losses, that triggered there, and additionally empower. Because if you have a support that is being held technically, then it shouldn't be a secret that a lot of traders, as a rule of thumb, are going to place their stop losses right under the lowest point, right under the swing low, the support. Yeah, so here in this case, it would be like 15,500. So if this support kind of like level breaks, then this triggers all those stop losses and all those traders positioned right below this trend line, or this trend level threshold, and it triggers and makes them sell off lower and cheaper. So this accelerates, the selling pressure. And if that happens, the miners are even more underwater. And if they are even more underwater, they'll have to sell off more quickly. So if they sell off more quickly, this takes the prices lower, and perhaps, accelerates the overall FUD, and people capitulating, and the retail traders capitulating. So this is a worst case situation, like a black swan event that happened also in 2018, if you remember, because December 15, 2018, Bitcoin actually bottomed out at 31 to 31.20 in here. And this is exactly what Bitcoin miners capitulation looked like. Bitcoin was trading at around $7,000, and then it slipped to $3,000. So 50% decline from those kind of levels that had seemed to be the floor and the bottom. So all that is again being said, to tell you that you have to be ready for the worst. You can hope for the best. You can really opt for the best, but you should be ready for the worst, because we have the recessive environment. There's an overall withdrawal and rejection of the risk, risk, I should say, thesis, for the next months. Traders are withdrawing. Traders show a lot of uncertainty and a lot of insecurity, moving into the defensive stocks, which tend to be this safe haven, apparently much more than the dollar right now. And this all together, combined with an overall strong underperformance and this unwillingness of traders to touch anything Bitcoin related, this definitely just does not let Bitcoin accumulate a lot of buyers. So I would argue that Bitcoin is really stepping on a very thin ice, and if things just turn not well, then it may happen that we actually just see this minus capitulation, and the chances for it increase the longer we stay underwater. The longer the miners stay underwater, the production costs get higher than the actual price of Bitcoin. So best for miners is for the price of Bitcoin to increase sharply and to increase a lot, so that they get above the break-even threshold for them. What we are looking at, however, is the sequence of failed breakouts. This is a 12-hour chart, my favorite chart, for Bitcoin with a 200-day trend. So this is the main resistance, right? You could see previously in the analysis that Dow Jones kind of like, did manage to break above, and right now it's pulling back to its 200-day trend. Bitcoin didn't ever kind of like climb as high even. Yeah, so it's already showing you a lot of disparity, a lot of underperformance. And if that is the case, then, well, we had just rejected also the highs of the following a potential breakout. So it's not really good looking if I was asked. Gun to my head, and I would tell you that this is leaning more bearish than bullish in the short term. So the fact that we had the failed breakout overall and the situation where Bitcoin climbed, slipped below the 17,500 support, which is the main support of June's lows, you know, um, and it kind of like, went higher above this level. This technically, like I said, validates this failed breakout pattern, this failed breakout, which typically makes the markets move better in the opposite direction. So the failed patterns, failed breakouts tend to move and revert strongly in the opposite directions, right? Because those traders who shorted, on the breakdown signal are now underwater, and they have to cover for the losses, club buying back higher for the shorts, and so on, right? And this, of course, is empowered by positive feedback loop. As many traders see, that traders are buying, so they are also going to buy. The certain effects, work, they get into work. So this is typically why failed patterns tend to perform better in the opposite direction. So same way, imagine you have a resistance, an overthrown peak, just like you see in here, and if the market just turns down, yeah, then this actually tells you that all those traders are trapped on top. Those who bought on the breakout signal to the upside, are now basically underwater, and they would have to cover for the losses. They would have to exit and close their positions for the losses, selling off lower. So there's an overall loss aversion, from the traders that don't really want to, just risk a lot of losses. They don't feel comfortable holding losses. Nobody likes losing. So if that is the case, it may only accelerate the reversal in the opposite direction, right? Because it would force them to sell off, and at the same time cause a lot of uncertainty and discomfort to the traders on site. So failed breakout on the bottom was technically bullish. However, it was followed by another failed breakout. But this failed breakout, the recent failed breakout on the FOMC announcement, is actually turning down. So the fact, like the way I look at it, the fact that we kind of like bottomed out, with a failed breakout at 15,500 was bullish on its own. We climbed higher over the 17,500, and good, we had a very good promising setup. However, this good promising setup was literally slashed and decimated. Yeah, so this failed breakout acts kind of like against the bottom in here. So this tells me that this failed breakout is supposed to perform better in the opposite direction. So instead of reaching the 200-day trend, we may actually just technically accelerate the sell-off to the downside. So again, another reason why I should say that this news-driven dump, on the price shock, on this price event, on the FOMC announcement, only accelerated the sell-off. And because there are not many buyers, there's not much comfort in the market. There's not much credibility. There's a lot of thought, uncertainty, and blackmailing, from the outside of crypto. And overall, minority of traders who are still left in the market when compared with the last year's bull top. This tells that the market is really vulnerable. It's really vulnerable and prone to taking, any sort of like weakest points. So it's an easy way down. It's a very hard way up, but it's an easy way down. So any kind of like a bearish trigger may accelerate the sell-off, but it's not going to be so easy to move up on any bullish trigger, mainly because the bear market resumes. This is a bear market curve. The 200-day trend represents represents the long-term trend, and this bear market primary trend. And this has not flattened out. Dow Jones has flattened out mostly. Bitcoin has not flattened out. So we cannot talk about the bearish market change for Bitcoin. It's still moving down lower consecutively, consistently, and it's just simply not looking ready to reverse. So if the dominant tendency is moving downside and there is not so much of a hope even in the chart, traders are not really given a lot of chance to feel hopeful about that, to feel hope, to feel really positive. Instead, this chart shouts down, That's what it says on average for the past 200 days. So this is the prevailing dominant leading tendency. And because of that, any upwards movement, is basically doomed and is vulnerable because it's against the main trend. I hope it makes sense. Yeah, so once again, like, answering again about and explaining through today's dump, we are only looking at this actual reasonable um, response from the market to the failed breakdown, right? To the failed breakout. So we had the failed breakout on top, and we know that this failed overthrown top pattern basically accelerates the sell-off and makes it perform stronger in the opposite direction. So this latest failed breakout kind of like annihilated, invalidated the one on the bottom. So if anything, with the declining bearish tendency, declining bearish market trend, and minus who are on the water, and there's an overall FOD uncertainty and not so much of positivity in terms of the energy prices or the Russia-Ukraine war. It's a very moment that Bitcoin stepping on a very thin ice, and it takes one wrong move, one wrong step to kind of like go, and break below the ice levels. So I would argue again, the safest way is to be ready for the worst and be hoping for the best. Yeah. So that is something that I do want to recommend to everybody. You don't have to rush to it any, kind of like, you don't have to win, force yourself to win. The market is going to be there. You have tons of plenty of opportunities. You don't have to fear and be afraid that the market is going to end at all, and that there's always going to be this another opportunity, this another train you can get on board. Yeah, so you don't have to kind of like press yourself to step into something that is very uncomfortable to be in, this very thin ice situation for Bitcoin. And you don't have to force yourself to bidder, because at times it's much better to kind of like stay sidelined, when the market is not giving you the chances to be any positive, and kind of like wait it through on the sideline. And this way, just maybe give yourself a chance to load on heavily when the market finally turns up. Hope it makes sense, guys. Please let me know. If you enjoyed this webinar. If you did, make sure you actually hit the subscribe button, smash the notifications bell, and hit the likes as well. Drop some comments and questions if you have any. I'll do my best to cover them off the show. And you're all more than welcome to comment, of course, comment our Discord on the Burbnest server. We're soon going to celebrate 5th anniversary. Can you imagine that? And by the way, thank you Zipu for 7774 the comment. I would have not done it without Mr. Burb Loftinest. Love you back as well on my own behalf, on the behalf of the Burbnest. You guys are amazing. And Tom Lee saying, long-time follower, Burb, keep up the good work. Thanks, Tom. I really appreciate it. Great job on listening and tuning into it. Neo1216, thank you, sir, for the amazing content you put out. Cheers. Cheers back to you, Neo. I definitely love this, and great nick. I love Matrix. Great nick. Great choice. Ladies and gentlemen, that's practically it that I wanted to get you for today's to the table. So I hope you enjoyed this video. I hope you enjoyed this webinar, and do remember that mark your calendars for 27th of December. 27th of December, you're going to actually have a special release. More details soon. God bless you all. See you around. Have a great weekend. Bye bye.